Welcome to lesson 3, and today we're going to discuss stock indexes. So, stock indexes are groupings of stocks, and they are done to chart the progress of the economy or a specific sector. And the three most common stock indexes that you've probably heard of are the Dow Jones, the S&P 500, and the Nasdaq Composite. So, basically, they're hypothetical portfolios that measure market performance. And the thing with stock indexes is they can't be directly invested in. And we'll discuss in future videos what mutual funds and ETFs are. But the main takeaway is that they're groupings of stocks that measure market performance or sector performance. So the most famous one, is the Dow Jones Industrial Average. So it's an index of 30 companies, and these 30 companies, which I'll show you in the next slide, are some of the largest companies in America. And it tracks these companies to reflect the performance of the economy. So I'll just show you the next slide. So here are the 30 companies that comprise the Dow Jones Industrial Average. So a lot of these companies you've heard of most of them, you probably interact with them pretty commonly. For example, if you're an iPhone user, a MacBook user, iPad user, anything like that, you use Apple. If you have a credit card, then chances are you're with Visa, or you might have Verizon as your cellular carrier. Or if you have a JP Morgan bank account, then you're using JP Morgan pretty often. Same with Microsoft. If you're using Windows, then you're using Microsoft. Nike, your shoes, your clothes. ExxonMobil, that's your gas in your car. Disney, that's for movies. Disney's expanding and getting even bigger, so it's interacting with us even more. And a lot of these companies, you'll notice that we interact with them pretty commonly, and they play a pretty big part of our lives. So that is in essence why those companies are part of the Dow Jones, in order to show the market's performance with those large companies. And basically, because we are consumers, then the Dow Jones reflects how consumers feel. If consumer spending with these companies is up pretty high, and that means that the Dow Jones was going to be pretty high because these companies are all doing well. So if the Dow Jones then is doing well, then that suggests that overall consumer sentiment and consumers are feeling upbeat and positive about the market. And another thing to note out of these companies, that they're all companies from both the NYSE, the New York Stock Exchange, as we discussed in the last video, and the Nasdaq. So for example, Apple, Microsoft, those are both Nasdaq companies, both tech heavy companies, whereas others like 3M, that's a NYSE company. So it has both um, in both the stock exchanges. So additionally, it gives greater weight to stocks with higher share prices. So if we look at this slide again, it's not just a simple mean calculation of 30 of adding the share prices of these 30 companies and dividing by 30. It's a weighted average where it takes into account the specific price of each stock, and therefore it takes that weight into account whenever it calculates the average. So for example, a company like, let's say, Nike, it is not valued as high as a company like Microsoft. So Microsoft would have a higher weightage in the Dow Jones Industrial Average than Nike would. Okay, so that's the Dow Jones. Now let's move on to the S&P 500. So you've probably heard of this one as well. It stands for the Standard and Poor's 500 Index. So similar to the Dow Jones, it takes companies from both the NYSE and the Nasdaq, but instead of being 30 companies, it's 500 companies. And because just like how in math or statistics, if you have a larger sample size, then it's chances are it's a better representation and better data set. Therefore, the S&P 500 is a better indicator of the economy's overall health. And I talked about that with the Dow Jones, but really the Dow Jones is just for quick glance, maybe let's say consumer spending, since a lot of these have to deal with consumers. Well, the S&P 500 is a lot more than consumers. Yes, it has companies like Apple, Microsoft, Walgreens, Walmart, but the S&P 500 will have tons more with 500 companies. So it'll have home building, it'll have financial companies, it'll have specific sectors like that that make the S&P 500 a better indicator than the Dow Jones. And then the final index that we're going to discuss today is the Nasdaq Composite Index. So if you think back to our last lesson, you might think, wait, wasn't there an exchange called the Nasdaq Exchange? Well, yes, and if we think about what was the Nasdaq Exchange, the Nasdaq Exchange was for tech-heavy companies. So similarly, the Nasdaq Composite Index has 3,300 different stocks, way more than the S&P 500 and the Dow Jones. But the companies in the Nasdaq Composite Index are only Nasdaq stocks. And because they're only Nasdaq stocks, therefore they're only tech stocks. So you're not going to have, say, Walmart, JP Morgan in the Nasdaq Composite Index. You're going to have your FANG acronyms, so Facebook, Apple, Amazon, Netflix, Google, Microsoft. Any tech company you can think of that you've probably heard of is probably in the Nasdaq Composite Index. And we can see that with the breakdown of the sectors that we see in the graph. So technology, 46.4%. So that's a very large portion of the Nasdaq Composite Index. And so the last two indexes, Dow Jones and S&P 500, those were all stocks, common stocks. But the Nasdaq Composite will have even more than that. It'll have depository receipts, real estate trusts. It'll just have a larger variety. So if we think back and recap to the three indexes we learned about today. Dow Jones, 30 large companies, brief glance at how the market is doing. S&P 500, larger sample size, 500 companies, better indicator of how the economy is doing. And the Nasdaq Composite Index, 3,300 different stocks, and indicator of how the tech sector is doing. So those are the three indexes used most commonly in assessing the US stock market, and additionally, these are the three indexes that investor performance is compared against and market performance is compared to. So these three indexes are going to be really important when determining how much risk you want to take in trying to beat these indexes and stuff like that. So for example, the S&P 500 in the calendar year of 2019, it averaged about it had a 29% annual increase, which is pretty large. So an investor who wants to beat the S&P 500 will want to invest such that they get more than 29% in the 2019 calendar year. So these three stock indexes, we're going to keep coming back to them, and they're very important in assessing market performance and assessing individual investor performance. So with that being said, that's going to be it for this lesson. If you liked the video, then I hope you subscribe and hit the thumbs up button. And that about wraps it up. So we'll see you in the next one.